The DTCC, the institution that clears and settles 3.7 quadrillion in securities annually and holds $100 trillion in custody across 150 countries, received SEC authorization in December 2025 to begin tokenizing its own assets on blockchain. Its CEO stated publicly that the goal is to put the entire depository on chain. 1 in 4 institutional investors now plans XRP exposure by year-end. And autonomous AI agents are executing financial transactions in 2026 without human intervention, creating structural demand for programmable money that the fiat system was not built to serve. The question of whether 1,000 XRP is enough has an answer, but the answer requires understanding what is actually being built and how close to completion it already is. Tonight, this is a complete framework for answering that question properly. We are going to build from the DTCC's documented tokenization roadmap, including the specific SEC authorization received in December 2025 and the second half 2026 service launch timeline, through the AI agent economy and why its structural demand for programmable money is the most underanalyzed demand driver in the entire XRP thesis, through the interoperability problem and why XRP's architectural profile matches the functional requirements of the tokenized financial system more precisely than any competing network, through the supply structure and what 1 in 4 institutions planning XRP exposure by year-end means for the available float against a fixed supply asset, and through the 2 qualifications that determine whether you benefit from being right on the thesis, self-custody and profit structure discipline, with the specific data on what percentage of retail investors fail on each of those dimensions. There is a section in this video on the AI agent economy that most XRP analysis is not connecting to the settlement architecture correctly, and that section changes how you think about the demand ceiling for XRP at institutional scale. Stay for that. This is not financial advice. Nothing here is a recommendation to buy, sell, or hold any asset. This is educational analysis based on publicly available institutional research, SEC filings, DTCC documentation, and documented market structure developments. Always do your own research and consult qualified financial professionals before making any investment decisions. If this is the channel that starts with the DTCC's actual SEC authorization letter rather than a vague reference to institutional adoption, hit the like button now. Subscribe with the bell on. Let's build this completely. Start with the DTCC, because this is the most consequential institutional development in the tokenization story, and it is being covered at a fraction of the depth it deserves. The DTCC is not a peripheral institution. It is the central clearing and settlement infrastructure for essentially every securities transaction in the United States. 3.7 quadrillion in transactions annually, $100 trillion in custody across 150 countries. When the DTCC moves, it is not a signal that tokenization is coming. It is confirmation that tokenization has arrived at the institutional infrastructure level, the level that cannot be reversed, cannot be canceled, and cannot be undone by a single regulatory setback. In December 2025, DTC, the DTCC's securities depository subsidiary, received a no-action letter from the SEC authorizing it to implement and operate a new voluntary service to tokenize DTC custodied assets. Frank LaSala, DTCC's president and CEO, stated publicly, "We plan to launch the service in the second half of 2026. The planned service launch targets highly liquid assets first, major U.S. equities, ETFs tracking major stock indexes, U.S. treasuries, and bonds. It is built on DTCC's Project Ion infrastructure, an existing blockchain-based settlement pilot that has been running in parallel with traditional settlement since 2021. And is designed to enable near-instant settlement, round-the-clock market access, and improved collateral mobility." In March 2026, the SEC granted Nasdaq permission to test investor choice settlement, allowing investors to select on a trade-by-trade basis whether to settle in traditional digital form or on blockchain, with Nasdaq partnering directly with DTC for the on-chain settlement pathway. The CEO's stated ambition is unambiguous: put DTCC's entire depository, the full $100 trillion, onto blockchain. When the institution that is the backbone of American capital markets publishes a roadmap with a stated goal of $100 trillion in on-chain tokenization and a second half 2026 service launch that has already received SEC authorization, the question of whether tokenization is real has been answered by the most credible possible source, The question that remains is which blockchain infrastructure handles the settlement and liquidity requirements of that $100 trillion dollars? And that is precisely where XRP's architectural profile becomes consequential. Now, the AI agent economy, the section I told you to stay for, because this is the demand driver that most XRP analysis is treating as a future narrative when it is already present infrastructure in 2026. Autonomous AI agents are software systems capable of executing financial transactions without human intervention, opening accounts, evaluating counterparties, routing payments, managing collateral, settling obligations, and optimizing yield, all at machine speed, across jurisdictions and asset classes simultaneously. In 2026, these systems are no longer experimental. They are becoming infrastructure. AI agents in 2026 are performing yield farming optimization, dynamic liquidity provisioning, cross-chain arbitrage, automated risk hedging, and prediction market operations, all autonomously, continuously, without a human in the loop. The macro implication is programmable capital at scale, markets moving toward continuous autonomous liquidity, AI-managed treasury operations, decentralized hedge funds, and machine-to-machine financial contracts. Now here's the architectural connection that most coverage misses entirely. When AI agents execute financial transactions autonomously at machine speed, measured in milliseconds, they require a monetary infrastructure that matches their operational tempo. Fiat correspondent banking settles in days. Swift messaging takes hours. Ethereum gas fee volatility makes transaction cost prediction impossible for autonomous systems managing tight margin requirements. XRP settles in 3 to 5 seconds. Its fees are fractions of a cent and are deterministic, meaning an AI agent can calculate the exact transaction cost before executing, budget it precisely, and scale operations across thousands of simultaneous transactions without fee unpredictability, creating cascading failures in automated strategies. Bitcoin cannot serve the AI agent economy. Its throughput is too low and its settlement time too slow for machine speed financial operations. Ethereum's gas fee volatility introduces a variable that autonomous systems cannot reliably budget around. XRP's purpose-built payment architecture, deterministic fees, 3 to 5 second finality, 1/500 transactions per second capacity, matches the operational requirements of machine-to-machine financial contracts more precisely than any competing network. The AI agent economy is not a distant speculative scenario adding to XRP's demand ceiling. It is a present and growing demand driver operating on the same infrastructure timeline as institutional tokenization, and the two demand streams, institutional settlement volume and AI agent transaction volume, are additive, not competing. Now, the interoperability problem, stated precisely because this is where the architectural comparison between networks produces the most important and least discussed conclusion for XRP holders. As the financial system moves on-chain, it does not move onto a single blockchain. It moves onto multiple blockchains, each optimized for different functions, serving different institutional constituencies, operating under different governance models. The European Investment Bank issues bonds on Ethereum. The DTCC builds on its Project Ion infrastructure. Central banks pilot CBDC infrastructure on permissioned ledgers. JP Morgan's Kinexys operates on its own blockchain network. Standard Chartered's SC Ventures builds on a separate architecture. The tokenized financial system of 2026 is already a multi-chain ecosystem, and multi-chain ecosystems require bridges. A bridge asset in this context is not a metaphor. It is a specific architectural function, a neutral, high-speed, low-cost medium of exchange that two parties operating on different blockchain systems can use to settle obligations between them without either party having to adopt the other's infrastructure. This is the function XRP was engineered to perform from the XRP ledger's original design specifications. The cross-currency, cross-ledger bridge settlement capability, denominated in XRP as the common settlement layer, is the function that makes XRP's design profile relevant to every institution operating on a different blockchain than its counterparts. Bitcoin does not perform this function by design. Ethereum's gas fee structure makes it impractical as a high-volume, low-cost settlement bridge at institutional scale. XRP's architecture was built specifically for this use case, and as the multi-chain institutional ecosystem matures, the demand for a neutral bridge asset with XRP's settlement profile compounds with every new blockchain that institutional finance adopts. Now, the institutional demand data, because the thesis only matters if the evidence of adoption is real and measurable, and in 2026 it is. A Coinbase Global and EY Parthenon survey of 351 institutional entities published in March 2026 found that the share of institutional investors allocated to XRP is expected to climb from 18% in January 2026 to 25% by year end, a 39% increase in institutional XRP allocation within a single year. XRP ranked fifth among all cryptocurrencies by planned 2026 institutional allocation. XRP ETFs recorded $65 million in inflows in April alone, reversing March's outflow entirely and putting April on track for the single largest monthly net inflow since launch. Cumulative XRP ETF net inflows stand at $127 billion, with 769 million XRP in institutional custody. Aviva Investors, a global asset manager with hundreds of billions in assets under management, announced a partnership with Ripple to explore tokenizing traditional fund structures on the XRP ledger, with Ripple President Monica Long stating publicly, "In 2026, expect institutional adoption at scale." These are not narrative claims. They are survey data, ETF flow disclosures, and documented institutional partnership announcements. The trajectory they describe, 18% to 25% institutional allocation in 12 months, $127 billion in cumulative ETF inflows, a global asset manager bringing traditional funds on-chain through the XRP ledger, is the institutional adoption curve in its early to mid-stage. Not its beginning, not its peak. The phase where the data is confirming the direction without yet reflecting the full magnitude of what the endpoint implies for the supply-demand structure of a fixed supply asset. Now, the supply structure, connecting the institutional demand data to the fixed supply reality that determines the price mechanism. XRP's maximum supply is fixed at 100 billion tokens. Circulating supply is approximately 61.3 billion, with approximately 33.9 billion in Ripple's escrow, releasing at a net rate of 200 to 300 million monthly after re-escrowing. As institutional allocation increases from 18 to 25% of the institutional investor universe, a universe representing trillions in allocable capital, the XRP moving into ETF custody and ODL operational reserves exits the speculative trading float. It does not return to exchange order books on weekly timeframes. It is held for institutional investment horizons measured in quarters and fiscal years. The exchange reserve data reflects this. XRP on major tracked exchanges is down approximately 57% from peak levels, reaching 8-year lows. At the same time, 57% of institutional crypto wallets have moved toward non-custodial or hybrid models, and institutions averaging 95 to 99% of holdings in cold storage are removing XRP from accessible market supply for extended holding periods. The supply shock thesis in its precise version, not price must spike because exchange reserves are low, but if institutional demand reaches the 25% allocation target, while the accessible float remains constrained across escrow, ETF custody, and ODL operational reserves simultaneously, the price mechanism has to adjust to clear the market, is supported by every data point in the institutional flow record. The Coinbase EY survey's 39% projected increase in institutional XRP allocation is the demand input. The fixed supply ceiling and the three-channel float compression are the supply constraint. The price discovery between those two forces is the mechanism. The timeline is the institutional adoption curve, not the retail sentiment cycle. Now, the two qualifications, because being right on the thesis and benefiting from being right on the thesis are not the same thing, and the data on where retail investors fail in exactly this situation is specific enough to be directly useful. Self-custody first. 46% of retail crypto holders report not feeling fully confident managing key recovery on their own. That confidence gap is the primary reason retail holders leave assets on exchange platforms. An exchange platform custody means you hold a liability on a counterparty balance sheet, not a digital asset. FTX held approximately $8 billion in customer assets before its collapse. Celsius held approximately $12 billion. Voyager held approximately $5 billion. In each case, customers who held assets on the platform discovered that regulatory proceedings, not their own decisions, would determine what they recovered. Self-custody is not an advanced concept for sophisticated investors. It is the foundational prerequisite for any XRP position that is intended to be held through the adoption cycle. If your XRP is on an exchange, no analysis of the institutional demand thesis, the DTCC tokenization roadmap, or the AI agent economy changes the fact that your position is subject to counterparty risk that is entirely within your control to eliminate. Cold wallet, hardware wallet, your keys. There is no version of this analysis where that advice is wrong. Profit structure discipline. Second, the behavioral pattern that prevents retail investors from capturing the full value of a correct long-term thesis is well documented and consistent across every market cycle. Retail holders accumulate through the consolidation phase, hold through the early rally, and sell the entire position at the first meaningful multiple, 5 times or 10 times their entry, book the profit, feel the victory, and watch the asset continue to appreciate for years toward the price levels that would have represented genuine generational wealth. The structure that historically separates wealth building from profit taking is layered rather than binary. Take some profits along the way to de-risk initial capital and cover downside, while retaining a core long-term position committed to holding through the full adoption cycle. Not because selling early is wrong, capturing profits is rational, but because selling the entire position at the first significant multiple, when the macro thesis is still in its early to mid-adoption phase, forfeits the portion of the trade that the thesis was built around. If XRP's price appreciation is structurally required by its utility, as David Schwartz stated directly, a higher-priced XRP is a better vehicle for payments because the larger the market cap of the bridge asset, the greater its capacity to absorb institutional settlement volume without price disruption, then the endpoint of the price discovery process is not $5 or $10. It is whatever price level creates the liquidity depth required to settle the institutional transaction volumes that the DTCC's $100 trillion tokenization roadmap, the Aviva fund structures, the Mastercard RLUSD settlement integration, and the AI agent economy collectively generate. That endpoint is not yet visible in the price. It is visible in the institutional behavior. And institutional behavior is what the flow data is showing you. Here is the complete answer to the question this video was built to address. Is 1,000 XRP enough in 2026? The answer is, enough for what, held how, with what structure, on what timeline. If enough means enough to represent a meaningful position in the liquidity layer of the tokenized financial system, the bridge asset that the DTCC's $100 trillion tokenization roadmap, the AI agent economy, the Mastercard RLUSD integration, and 25% institutional allocation by year-end are collectively requiring, then 1,000 XRP in self-custody, structured with layered profit management and held through the institutional adoption cycle, is a position whose potential is defined by the endpoint of that adoption curve rather than by the current speculative trading price. What makes 1,000 XRP insufficient is not the number. It is leaving it on an exchange, selling the entire position at the first significant multiple, or holding without understanding the thesis well enough to maintain conviction through the drawdowns that every adoption cycle produces between now and the endpoint. The DTCC's service launch is scheduled for the second half of 2026. Aviva Investors is bringing traditional fund structures on-chain through the XRP ledger now. Institutional allocation is growing from 18 to 25% within this calendar year. AI agents are executing financial transactions autonomously on blockchain infrastructure in 2026. None of these are predictions. They are documented present-tense developments, and they define the environment in which 1,000 XRP held correctly is not a speculative position. It is a macro position in the infrastructure of the next financial system. If this gave you the complete framework, the DTCC's actual SEC authorization and $100 trillion stated goal, the AI agent economy demand driver with the specific architectural connection to XRP's settlement profile, the interoperability problem, and why the multi-chain institutional ecosystem requires a bridge asset with XRP's exact characteristics, the Coinbase EY survey's 39% institutional allocation growth figure, and the 2 qualifications grounded in the specific data on where retail investors fail, smash the like button right now. You stayed for the full analysis, including the AI agent section that most XRP channels are not connecting to the settlement architecture correctly, and that tells me you are building your conviction on the right foundation. Share this with one XRP holder who is uncertain about whether their position is large enough, because the question of how much is enough is less important than the question of how it is held and how it is structured. Subscribe and hit the bell because the DTCC second half 2026 service launch, the Clarity Act markup window, and the April XRP ETF monthly flow record are all resolving in the same calendar window. And when any of them produces a definitive signal, the breakdown is here within hours. Tell me in the comments, which of the 3 demand drivers, institutional tokenization, AI agent financial transactions, or ODL cross-border settlement, do you think reaches meaningful scale first, and why? See you in the next one.